You have money and you're ready to invest. You might have sold a business, earned a bonus, maybe you sold your house, or you've just saved up some cash over time and you have a lump sum sitting in a bank account. The question now isn't whether markets go up over time, it's whether today is the wrong day to start. It's a terrifying question for a lot of people. What if you invest all of the cash and then you timed it perfectly wrong? And now the market's down 40%. Your money's just gone. Today we're going to talk about that. When should you invest a lump sum of cash? I'm your host, Eli Freeman. As always, let's look at the data. Today we are looking at Nick Maggiulli's article titled Dollar Cost Averaging versus Lump Sum, All You Need to Know. All of the data and information in this video comes from his research and study, so reference that if you'd like to see more. Nick Maggiulli's analysis separates two approaches: lump sum investing, which is investing all available money immediately, and dollar cost averaging, which is deliberately holding part of the available money in cash, but you invest equally in installments over time. That distinction matters. Regularly investing each paycheck or contributing to a 401k is not the kind of dollar cost averaging that's being compared here. In those cases, you're typically investing each new dollar as soon as it becomes available. The real question of today is what to do with a pile of cash that is already investable. Without beating around the bush, the core result, just to sum it up, is investing sooner usually wins. Maggiulli's central argument is straightforward. If an asset tends to rise over the long run, owning it earlier gives it more time to compound an interest. Gradually moving cash into the market means some money sits on the sidelines while the market may be rising. In his 24-month comparison of U.S. stocks since 1997, dollar cost averaging underperformed an immediate lump sum investment in 80.6% of starting months. On average, it lagged by 10% by the end of the second year. However, that does not mean lump sum investing wins every time. It means it has historically been the higher probability choice, and that's an important distinction. A useful way to frame it, dollar cost averaging is not a free protection plan. It reduces exposure to a possible near-term decline, which can feel good, but it also reduces exposure to the market's usual upward drift. And investing most of the time should be a probability choice and not an emotional choice, even though emotions can tend to win out. Dollar cost averaging does shine if the market falls immediately after you begin investing. If stock prices decline during the buying window, later purchases buy more shares at lower prices. That can allow the gradual investor to end up ahead of someone who invested all of the money at the starting price. Historically, the major periods in which dollar cost averaging beat lump sum investing were associated with market crashes or long declines, such as 1974, the aftermath of the dot-com bubble, and 2008 or the Great Recession. But there's an important behavioral twist. The environment where dollar cost averaging is most valuable is also the environment where people are least likely to continue dollar cost averaging. Buying month after month while headlines worsen and account balances fall takes real grit and discipline. If you're a rule follower, it will probably be easy to stick with this. But if you are not, it can be very difficult to put money in every single month when you're seeing your previous cash decline in value. Nick goes on to talk about that this is not just a US stock result. The article extends the test across asset classes over 1997 to 2022. I'll put the chart on the screen for your reference. In every asset class that he examined, dollar cost averaging lagged lump sum investing by at least 4% on average over the 24-month buying window, and it trailed in the large majority of possible starting months. The gap varied by asset, obviously, but in assets that rose especially sharply, delaying investment was especially costly. Maggiulli notes that Bitcoin's historical run produced a dramatically larger average shortfall for dollar cost averaging, but that figure really should be treated as an illustration of the timing principle and not a forecast or endorsement of Bitcoin. Risk changes the story, but not as much as many people expect. Lump sum is more volatile during the investment period because all the money is immediately exposed to the market. Dollar cost averaging stays partly in cash, so its short-term results are smoother. And that's a real benefit, especially for someone who knows a sharp early loss could cause them to abandon their financial plan. However, the article makes a more nuanced point, and one that I really enjoyed reading. Taking less risk through delayed investing is not the only option. In the historical examples, immediately investing lump sum in a 60-40 stock bond portfolio often outperformed dollar cost averaging into a 100% stock portfolio, while taking roughly similar risks. I want to say that again. Immediately investing in a portfolio that has 40% invested in lower risk assets than stocks often outperformed dollar cost averaging 100% into stocks. That stat really shocked me as I read through the article. So the question may not be, should I slowly buy a risky portfolio? It may be, is my portfolio riskier than I can truly tolerate? In Maggiulli's tests, funding the sideline cash with treasury bills returned reduced dollar cost averaging average underperformance depending on the asset class. It also improved dollar cost averaging's risk-adjusted results. Still, it did not erase the return gap across the tested asset classes, and it assumes something that investors failed to do in practice, consistently placing the cash in a high-yield bearing, low-risk vehicle, and continue the buying plan even if markets are falling. To summarize, Nick suggests if you have a long-term portfolio, you believe in the investments, and the money is truly ready to invest, the historical odds favor investing it sooner rather than gradually waiting for a better price. One might choose dollar cost averaging when its behavioral benefit is valuable enough to you that it helps you follow through with the investment plan. If a gradual plan is what prevents you from staying in cash indefinitely or prevents panic selling after a decline, it really could be a sensible personal financial decision. But do not confuse more comfortable with more likely to produce the better return. Those are very different things and different goals. The uncomfortable truth is that there is no strategy that protects you from regret. Invest all at once and you may see an immediate drop. Invest slowly and you may watch the market rise while your cash sits on the sidelines. The data cannot eliminate that discomfort, but it can clarify the trade-off. Historically, the price of feeling safer has usually been lower returns. The better question is not, can I find the perfect day to invest? It is, can I build a portfolio and a process that I can stick with even after I invest, no matter the outcome. If you enjoyed this video, I have another video about when you should withdraw from your investment portfolio, then I'll link that below in the comment.